Hey y'all, this is Mindy Strong. This video is to help you better understand the concept of fundamental analysis if you're studying for the Series 65. Hope this helps. This should be used in addition to a study program, not in lieu of. Okay, so fundamental analysis. First of all, we have fundamental analysts, and they're going to look at a company as a whole. They look at the product lines, the outlook, the management of the company. Then they're going to look at the income statement, the balance sheet, and any changes to returned earnings. So they take a fundamental analysis of the company. They look at the company as a whole and then break it down. There are two main methods of accounting that are used. One is the accrual method, generally used by larger companies, and the cash method, generally used by smaller companies. The accrual method is going to record the date that a sale is made, not the day the money is received. So that means that you can see money coming in and out using the accrual method sooner than with the cash method. The cash method, contrarily, is going to record everything the date the money is actually received. So you're going to see the money coming in and out later with the cash money method. Accrual method, you record the date the sale is made. Cash method, the day you receive it, the money itself, okay, or the date you pay the bill, cash method, versus the date you were billed, accrual method. Got it? Get it? Good. Income statement. An income statement shows the revenue and expenses for the year, just the year. And this is going to include the gross sales, which are the billed sales, the returns, the net sales, which is gross sales minus the returns, the cost of goods sold, the gross margin, which is the net sales minus the cost of goods sold, the operating expenses, the operating margin, which is the gross margin minus the operating expenses, the non-operating income, the total income, the bond interest expense, which is non-operating, the net income before tax, the taxes themselves, and the net income after taxes. So we're going to get into detail here of how to actually calculate these things. But for instance, you need to know if they ask you about the gross margin, you're going to have to take the net sales and subtract the actual cost of goods sold. Understanding the concept of these is very important, because then these aren't formulas you need to memorize. This is common sense. For instance, net sales, we know that we take the gross sales and we subtract away the returns, and that gives us the net sales. Same thing with operating margin. We have to take the gross margin and take out the operating expenses. Gross margin, you take the net sales minus the cost of the goods sold, okay? Because we obviously have to subtract the amount that we paid for the goods from the net sales in order to understand the gross margin. The operating margin of profit ratio is what is the percent of profit that the business is actually earning on sales. So you take the operating margin and you divide that by the net sales. The operating margin of profit ratio is going to be the operating margin you're working with divided by the net sales. The final profitability, also known as the net profit ratio. What is the final? What's the net? After everything's taken out of it, what are we actually left with as our profitability percentage? So we take the net income after tax and divide that by the net sales, and that tells us our true final profit. Earnings per common share, we're going to get into this in more detail later, but the idea of identifying your earnings per common share is important. You take the earnings available for common and you divide that by the common shares outstanding. That's going to give you your earnings per common share. I would absolutely make a flashcard for this. This is a formula that you want to make sure you have memorized. Then there's the dividend payout ratio. What are we actually going to be, the ratio, the percentage that we're actually paying out in dividends? You're going to take the common dividends that have been paid and divide that by the earnings for the common. And that's going to give you the dividend payout ratio. I would absolutely make a flashcard for this. So we talked about the income sheet. What is the balance sheet? This is the snapshot of all of the assets and liabilities. And it's going to be organized from most liquid to least. So the net worth is going to be the total assets minus the total liabilities. That's the net worth of the company. Total assets minus total liabilities is your net worth. Then we have to look in detail at what is actually liquid. So when looking at what's liquid on a balance sheet, we've got the cash, we have the marketable securities, and the accounts receivable. Those are all highly liquid. So if you're asked about the liquidity of a company, you're going to look at the cash, marketable securities, and accounts receivable. Those are all extremely liquid. The current liabilities are going to be the accounts payable, the wages payable, the taxes payable, and the interest payable. Those are the current liabilities. And then we have net working capital. So we talked about net worth, which is total assets, total liabilities. But now we want to know the net working capital. What is our actual capital that we can utilize immediately for the business? And that is taking the current assets minus the current liabilities. So the current ratio is going to be the current assets over our current liabilities. Net working capital. What do we have to work with? That's a great way to remember it. What are we actually working with here? What do we have to work with? And then we have the quick ratio. So this is immediate. I can get my hands on this right now. So we take the current assets and we just take out anything that's illiquid, such as inventory. And we divide that by the current liabilities, and we have the quick ratio. Long-term capital is what money do we have coming in over the long term? What can we depend on coming in? Well, we have our long-term liabilities and we have our stockholder equity. And I divided those up for you so we can understand what stockholder equity is actually comprised of. So our long-term liabilities is also known as our long-term debt. And then we have our preferred stock, which is one of our types of stockholder equity. We have our common stock, which is another stockholder equity. And that can be broken down into capital at par, capital in excess of par, and retained earnings. So if we take preferred stock and all three types of common stock, we add those together, that is the total of our stockholder equity. And then we have the long-term liability, which is our long-term debt. When you add all of that together, you get the long-term capital. Okay. And then we have one more formula for you, debt to equity ratio. So we take that long-term debt and we divide it by our stockholder equity, and that is going to give us our debt to equity ratio. That is the basis for the fundamental analysis. And again, this should help you with your Series 65 setting. Hope this helps. Have a great day.